When illicit cash flows meet rigid corporate structures, the resulting friction quietly destroys millions of dollars in foreign investment. Take this proposed $5 million baht minority acquisition of a cash-heavy nightlife asset located inside Bangkok's restricted entertainment zones. This is a high-reward environment, operating under strict regulations. Standard Western mergers and acquisitions assumptions fail completely here. To deconstruct this deal, we rely on a specialized due diligence dossier. The document opens with a blunt directive to the foreign buyer: engage local, daylight counsel before committing a single cent of capital. A typical offshore investor attempts to cap their ownership at the legal maximum on paper, while deploying secret side contracts to retain absolute operational control. Building defensible risk in this jurisdiction requires discarding those shadow structures entirely, shifting from paper audits to physical forensics, and strictly gating the release of funds. The regulatory boundary is absolute. Under the Thai Foreign Business Act, foreign nationals may hold a maximum of 49% of a company. Investors frequently attempt a loophole by secretly funding the local partner's 51% stake for total control. This criminal nominee arrangement carries prison sentences for both parties. Authorities now aggressively cross-reference the local partner's bank accounts to verify independent capitalization. Investors often double down on the illusion of control by relying on shadow contracts, hidden side letters, undocumented loans, and undated blank share transfers. Under Section 150 of the Civil Code, any contract designed to bypass the law is instantly rendered legally void. If a dispute occurs, the foreign investor cannot sue to enforce these shadow contracts without simultaneously confessing to a criminal offense. The buyer has actively spent capital to systematically destroy their own legal standing. The only protection that actually functions is a daytime structure capped at 49. The most lucrative margin rests on the bar fine, a direct payment to take a worker off shift early. This specific stream carries 3 to 15 years of imprisonment under the Prostitution Act. The risk escalates catastrophically with age. If a single worker on the premises is under 18, the penalties expand to life-altering asset forfeiture and human trafficking charges. For foreign investors, this exposure is extraterritorial. Criminal liability follows citizenship, regardless of where the investor resides or pays taxes. Statutes like Divisions 270 and 272 of the Australian Criminal Code aggressively prosecute citizens for offenses committed overseas. Even standard facilitation payments, the daily tea money paid by the venue to operate, instantly trigger foreign bribery clauses for the offshore investor. There is exactly one operational shield against this liability: maintaining 100% documented, government-issued ID verification and valid work permits on file for every single worker. If the deal's financials rely on optimizing exposed revenue streams without ironclad ID compliance, the investor is not acquiring a business, they're acquiring criminal liability. Beyond the staff, the physical real estate presents its own binary risk: the legal right to simply open the doors. In standard mergers, buyers assume that operating licenses are simple corporate assets that seamlessly transfer to the new ownership. The Entertainment Place Act makes licenses intensely personal, tied exclusively to the applicant, not the corporate entity. It's also locked to the specific premises. New operators cannot inherit it. They must apply completely from scratch. This creates an immediate regulatory vulnerability. Local district offices and police retain absolute discretion to delay, deny, or attach new conditions to the application. Paying key money or goodwill to the seller before the new license is fully secured introduces catastrophic risk. If the application is denied after payment, the investor owns a share of a dark, unopenable room, generating zero cash flow. Capital release must be entirely and exclusively contingent on written license approval. Applying for the license means nothing until it is granted. Surviving these extreme risks requires translating them into a strict, non-negotiable sequence of conditions precedent for capital release. Looking at this execution flowchart, Step 1 is incorporating a perfectly clean corporate entity to ensure no historical debts or liabilities travel with the acquisition. Step 2 requires executing a daylight shareholders agreement before a single cent of capital is committed to the venture. Steps 3 and 4 involve applying for the license, placing a rigid halt on the deal until it is granted in writing. Step 5 triggers when written proof exists. The lock opens, allowing funds to release in one traceable payment to the payee. The red lines for the investor are absolute: no shadow equity, no unverified staff, and no untraceable cash payments. Enforcing systems over people is the only method to survive a market driven by informal handshakes and manufactured scarcity narratives. This brings us back to the foundational axiom of the entire due diligence dossier. In high-risk frontier jurisdictions, if a right, an asset, or a protection isn't verifiable on paper, it simply does not exist.